Well, as we were mentioning, one of the catalysts for the stock market gaining ground today is a growing belief on Wall Street that we could see interest rate cuts by the U.S. Federal Reserve as soon as September. That belief seems even stronger after the latest inflation numbers. Olu Sonola is U.S. Head of Economic Research with Fitch Ratings and joins us now to talk a little bit more about the inflation picture. What was your overall take, Olu, on what the price reality is for the U.S. economy right now?
Thanks for having me. My overall take is that we're starting to see the impact of tariffs, but it's still a lot slower than expected. I would call it slow but steady. In the coming months, that's what we're likely to see. I think the market is obviously very, very happy that you're not seeing that spike, but it's clear that that is in the numbers and it's likely to accelerate going forward.
So interesting, a slower but steady inflationary impact. And would you say there's also a reason to be cautious on in the economy itself? I only say that because you had a weak U.S. jobs report a couple of weeks ago, which was one of the reasons why you started hearing traders talk more about interest rate cuts.
Yes, I think you have to factor that in, and the Federal Reserve will have to factor that in. You have a much weaker labor market. Now, sometimes it also depends on how you look at it. If you look at the unemployment rate, you may say it's 4.2%. That's not so bad. But the Fed will be paying a lot of attention to that jobs report that we saw, particularly the downward revision. Outside of that, you also have to pay attention to the economy as a whole. I know that third quarter GDP was about 3%. But the reality is once you exclude the volatile components and all of the front loading and pay forward that we saw, we have an economy whose run rate is about 1.5%, about half of what it was during the second half of last year. So the combination of a slowing economy, a slowing labor market, and accelerating inflation puts the Fed in a bind. But I think clearly this time around, they're going to pivot more to the weakness that we're seeing in the labor market.
And deal with the inflationary consequences. So you wouldn't be surprised then, like the percentage of traders that think that the Fed will cut interest rates in September has just been steadily going up. That wouldn't surprise you if they were to cut next month?
No, it would not surprise me at all. And September looks to me like they have to go. They cannot be behind on the labor market. All the while, the leg they had to stand on was, hey, we have a labor market, we still have job growth, the unemployment rate is steady, the labor market is balanced. I don't think they can say that with a straight face going forward. The weaknesses in the labor market are clear, and they would want to at least address that going forward. It's not just a function of signaling anymore.
And what do you think, Olu, that messaging from the Fed, given the balancing act, let's just make the assumption they ultimately cut rates, but they're, as central banks always do, trying to manage the market in the face of that? Because I was saying earlier in the program today that the Bank of Canada, which has already cut rates more aggressively over the last year or so than what we've seen from the U.S. Federal Reserve, because of that, there's actually less market participants that think that the BOC would cut rates next month. But I would imagine they're going to have to very closely monitor what the Fed is doing.
Yeah, absolutely. I think the Fed, the messaging is going to be very, very tight. I think because clearly we're going to get another jobs report. We're going to see another inflation report. The expectation is that inflation will continue to move slowly but steadily higher. But their messaging will hinge on, hey, we know inflation is going to increase. We're hoping, or we think, it's not going to be persistent. We think it's tariff induced, and we think that's one time. And we'll keep our eyes on it. But I think we cannot ignore the weakness we're seeing in the labor market. Now, they may also go one step ahead to say the inflationary pressure that's building, we will reflect that in the pace of cuts. So we're not going to cut every meeting. We may cut every other meeting, or we may cut once and all the other meetings are live. So they're not going to signal that it's a rate cut, it's an aggressive rate cutting cycle. They're going to want to get the message across that we're cutting once, and we'll see how the data unfolds before we decide to cut again.
And I know you don't comment on the stock market itself, but I think the stock market has looked at that idea of at least a pivot towards rate cuts as something to smile about. But I guess what kind of economy in that scenario where maybe they cut, maybe they pause, maybe they cut again, like how would you describe the kind of economy we're setting up for heading into the final months of 2025, in your opinion?
It's going to be continued slowdown. I think we have brought annual economic growth at 1.5. That was essentially where we are, or where we were during the first half of the year. We think that slowdown will continue. Consumer spending has actually slowed quite a bit, somewhere around 1%. If you focus on the first half of the year. That's what we'd expect because, inflation would increase, that real income across households would increase. Now, if you fast forward a little bit into 2026, the impact of that one big, beautiful bill will probably offset some of that weakness because people will start to see a lot of money in their tax returns during that first and second quarter of 2026. But through 2025, clearly, the pressure and the risk is much more to the downside.
And just a final question. You mentioned that we're seeing traces of inflationary impacts from the trade story. What do you think will be the determination on whether those ramp up? Like we're sitting here in Canada, we're wondering if there's going to be some kind of trade arrangement with the United States. And so I wonder, is the nature of the deals, which so far have not included a lot of retaliatory steps by other nations, but is the nature of those deals still going to sort of factor into your estimates for what the inflation from tariffs looks like down the road?
Yes, certainly it will. I think we're talking about an effective rate of at least 15%, somewhere between 15 and 17%. It's significantly higher than the 2.5% we had last year. That is going to filter through because at least half of the goods that we import are consumer-related goods, right? The other half are raw materials and intermediate goods. So for the consumer-related goods, you can only take a hit for so long as a manufacturer or as a retailer or as the importer. At some point, you have to decide, okay, how much of this am I going to pass on and how much of this will I be able to take on? For corporate America, margins are quite high. Maybe they'll be able to absorb some of them. But for the vast majority of small businesses, medium income businesses or middle market businesses, they probably don't have the wherewithal to absorb a big chunk of those tariffs. So eventually they will have to pass those on. We think you'll start to see more and more of that over the coming year. And it's just a matter of fact before we think inflation headline inflation, which is still below 3% now, we think that's going to head much more towards 4% as the months go by, probably around this time next year, or even by the second quarter of 2026.
Okay. Helpful context as always, Olu. Thanks very much. Olu Sonola joining us, U.S. Head of Economic Research at Fitch Ratings.